something is going on in the gold market that I don't understand and nobody seems to understand. There's lots of speculation and theories, but if you look at the gold deliveries in COMEX, you will see that every month this year, they're at least 200% higher than the equivalent month last year. So that means each month the deliveries are 3 times what they were a year ago. This month, which is May, we're only halfway through it, the deliveries are 700% higher than May last year.
Gold has surged nearly 80% since late 2022, but with shifting economic indicators and market volatility, investors are questioning whether it's time to cash in or hold steady. In the first quarter of 2025, a whopping 7 million ounces were added to global gold exchange traded funds. The bulk of this was in China, where private citizens could not locate sufficient quantities of physical gold to purchase and could not acquire enough futures contracts on the Shanghai Futures Exchange. Clive Thompson believes this is a clear sign that something big is shifting behind the scenes, possibly pointing to severe stress in the current monetary system or a move toward a gold-backed alternative. He mentioned that something unusual is happening in the gold market that even experts can't fully explain. When President Nixon closed the U.S. Treasury's gold exchange window on August 15, 1971, global central banks held about 90% of their reserves in U.S. dollars and U.S. Treasury debt. U.S. assets have made up only about 60% of central bank reserves in recent years. This decline was primarily due to the decrease in the use of the U.S. dollar in international commerce. However, in recent years, there has been a decided shift away from holding U.S. reserves out of fear of the falling value of the U.S. dollar. Thompson mentions that just like the previous system reached its breaking point, today's dollar-based system is also reaching the end of the road. He suggests that the next global monetary system could be backed by gold again. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
I think what's also going on is that large countries like China and probably India as well, can see that the writing is on the wall for the present system that we have. In 1944, we had the Bretton Woods Conference, and whether this was expected by the participants or not, what actually happened was the United States said, look, we've got the most gold. Why doesn't everybody go on to forget about a gold standard, which is very inconvenient because you're moving gold across the oceans with all the risks and work and costs. Why don't we go onto a dollar standard, and we will be willing to exchange your dollars and everybody's dollars for gold on demand. The whole world in 1944 went on to this gold standard, or rather the dollar standard, which was effectively backed by gold. And that worked perfectly up until 1971, when more and more countries were saying there's too many dollars out there compared with the gold you're holding. Let's convert our dollars back to gold. Thank you very much. And so in August 1971, Nixon closed the gold window. It's sometimes known as the Nixon shock. And from that date on, the gold price traded freely. But of course, the fact was there was already a lot more debt out there than could have ever been serviced by the gold that the United States had. And of course, the gold price then took off and has barely looked back since. But the trouble is, we're now at the end of the road, I think, with the current system, and it's time for a new system. And a natural new system, in my opinion, might be some sort of gold-backed system. So whether that comes out of the BRICS nations, I'm suggesting a hypothetical situation, but let's say countries like China have a lot more gold than they say they have, which is a possibility, and the BRICS nations get together and agree that they will have a monetary system backed by gold, of which China will be the holder of gold and issue all the renminbi, and everybody can, or maybe it'd be a new currency, it'd be the BRICS currency, and everybody will change their money backwards and forwards electronically, which is far more convenient than moving the gold around. But if there's a trade imbalance, that BRICS currency can always be converted back to the gold, which is held by a central bank for the BRICS nations. This could be coming, and of course it could be coming for the United States. So what would happen? Let's imagine some event happens tomorrow, and you wake up on Monday and you suddenly have an announcement from the president, we're now on a gold dollar. And by the way, there's a temporary restriction on converting your old dollars to the gold dollar.
Well, I mean,
so those who've got the gold will be fine, but those who don't will be scrambling around to see if they can get some, because that's the only thing you'll be allowed to spend. Everything's possible. Let's look at it. It's happened in one night before in the United States. Let's go back to before they called in the gold with the executive order of 6102 in 1933, which I think was on the 5th of April, 1933. But about 2 months before that, with the stroke of a pen, Roosevelt closed the banks for 2 weeks. When the banks opened, everybody who was in the know said, oh my God, America's in trouble. We might not be able to get our gold anymore, which actually did in fact happen. So what did they do? They couldn't get the gold out of the banks because the banks were all nearly bankrupt and didn't have the gold and weren't handing it out anyway. So what did they do? They rushed into the stock market. The stock market that day had the biggest gain in all of history, and then proceeded in the next few months to go on and increase by another 100%. It was the next best thing because you couldn't get your hands on gold. And then a month or two later, on the 5th of April, he basically issued this executive order saying, I order everybody to hand in their gold. You're not allowed to have gold. We're still on a gold standard, but you can't have it. So it wasn't really a gold standard at all. And then we had another overnight event on the 31st of January 1934. On the 31st of January 1934, but what did they do the day before that? The day before they devalued it, they said to the government passed a law ordering the Federal Reserve to turn over all its gold in exchange for government notes at the official price of $20.67, revalued the dollar at $35. And the Federal Reserve was mightily pissed off that it missed out on this huge profit. Well, actually, what they did, we all say they revalued gold, but what they actually did technically was reduce the amount of gold in the dollar, because the dollar was gold. So I don't remember how many grains of gold, let's say it's 40 grains, they reduced it to 20 grains or 25 grains. So basically what that meant was that the Federal Reserve had missed out on billions of dollars of profit overnight. But it wasn't just the Federal Reserve who lost out. All around the world, bankers, Paris, in London, in Zurich, who were holding some dollars, suddenly found their dollars were worth that much less. And that happened in one night. And, another example of that is when the euro dropped by literally within a few seconds, 30% against the Swiss franc. I think it was about 2015. Now, actually, it was the Swiss franc which broke the peg. So Switzerland was on a peg to the euro at a fixed rate of 120. 1 Swiss franc and 20 cents would buy you a euro. And that was a peg. And then one day, without any warning and in market hours, the Central Bank of Switzerland said, we're no longer going to support this peg. And within seconds, euro plunged, or if you like, the Swiss franc soared, and it went from 1 Swiss franc 20 to buy a euro down to about 80, 90 cents in seconds, and then it bounced around, it settled around 105, 106. That was another example where a currency can change its value rapidly. And then, of course, let's not forget when Great Britain and the pound plunged, I think it was 20 or 30% in a day, as they suddenly said, we're not supporting this anymore. So we can have huge currency lurches. And yes, so it could happen that overnight we suddenly find ourselves on a new gold standard, where we've got two currencies operating. We've got the gold dollar and the old dollar. But the old dollar isn't going to be worth 1-to-1 against the gold dollar.
Until mid-2024, many gold producers faced structural challenges, and balance sheet issues were one of the primary factors holding investors back from putting money into gold equities. Between 2020 and 2023, average all-in sustaining costs rose from $950 to $1,300 per ounce. The increase was driven by rising prices for energy and other essential materials needed in the mining process. Additionally, supply chain disruptions caused delays in shipping equipment to mining sites and delivering mined materials to refiners and vendors. On a similar note, increasing travel and accommodation costs and challenges due to new on-site health and safety protocols impacted the labor force. Clive also believes gold mining stocks are still largely ignored by most investors. After 12 and 13 years of poor performance, many people still avoid them. Clive thinks the real wave of investment, the big money, hasn't arrived yet. He believes it won't come until large-cap tech stocks like Microsoft, Nvidia, Google, and Meta slow down. Now, let's redirect our attention to a video.
There's always something happening in the world where you can jump on board and take advantage of it. And the one thing which is going on is the gold price. The gold price has risen way beyond the expectations of analysts when they last reported or last reviewed company results 6 months ago, 3 months ago, whatever it was. So what this means is that the profit forecasts of the analysts for the relevant gold mining companies are lagging the likely reality of what those profits will be. So if you factor in gold price, maybe you can still knock $500 off for fun. So factor in, let's say, $2,800 for the gold price instead of the current price, which is currently 3,200 and something. And when you put that in, and by the way, you don't have to do this yourself if you don't want to. Again, this is another exercise where you get AI to do it for you very quickly. You will discover that the expected earnings of these companies 1 year from now, 2 years from now, 3 years from now, based on that assumption of the current gold price or even a lower gold price today, is higher than the analysts are currently predicting. So according to my maths, and I've worked out for a fair number of gold mining companies, there's lots of them where the price earnings ratio will next year be well below 10. And I'm talking sometimes, six to nine levels, which is a very low price earnings ratio. It's a very cheap company. And that would be so let's assume the share prices don't rise. I mean, I think they will though, but let's say if the share prices don't rise, you will then have a very low price earnings ratio in a company whose earnings are growing very fast. Does that make sense? Doesn't. Yep. So what will happen? The share price has to rise because that's what robots do. They buy companies which are cheap. Of course, we don't have a lot of people investing in gold mining shares yet because they've gone through 12, 13 years of seeing these shares go backwards.
What's a good ticker symbol for gold miners? Use GDX or something else?
GDX is the mainstream ETF, which follows the large gold mining companies, and GDXJ follows the junior gold mining companies. That's an ETF. So if you look at, there you are. You've got the long-term chart there going back to 2009, 2010, and you can see that gold mining stocks are below where they were in 2010, yet the gold price is significantly higher. So they're just starting to take off. But I think what the real money hasn't arrived yet. The real money won't arrive unless or until, well, I'm not going to say unless, I'm going to say until, because I think it's more of until there's a long-term pause, the mainstream large cap stocks, the ones which every fund manager, every investment manager is buying to stay in the pack, i.e. the Microsofts, the Nvidias, the Intels, the Googles, the Facebooks, and so on. So when those large cap stocks come to a pause, and I know we're sort of in an up and down phase at the moment, so it might be looking a little bit toppy, but we don't know that yet. It's too early to say for sure. But if they do come to a sort of grinding halt and stop rising, then investment managers are going to be looking around for something which is growing, both in terms of momentum, either share price going up, or we've got that, in terms of earnings, we've got that, and in terms of being cheap, well, we got that. So the gold mining stocks meet those three criteria. So I think that's where the opportunity arises is at the moment. But, just to sort of say every moment in time, there's always something out there which looks like an opportunity. What we're seeing from your chart there is that an ounce of gold will buy you 3 times as many gold shares as it would have done in 2008 or 2009. What that means is gold shares mining companies have significantly underperformed for a decade or so. And now, obviously, people are going to say, well, if they've underperformed a decade, they're probably going to carry on underperforming. I don't think that's true. I mean, we only have to look at the period from 2000 through to about 2011 or 12. And we'll see, I don't think you'll do the GDX for that one, but you'll see that the gold price in that period went up many hundreds of percent to 200 or 300%. And in the same decade, the S&P 500 had a negative return.
Gold is back in focus, and with good reason. After a series of record-breaking performances, it is now in vogue for investors looking for a hedge against inflation, geopolitical risks, and market volatility. Gold purchases from central banks have resulted in incredible momentum, helping to set new records in 2024. Support came from investment inflows from Asian investors, while Western investors remained on the sidelines until late 2024 to early 2025. Coinciding with their return was considerable uncertainty, as the Trump administration's trade policy had investors looking to gold as a hedge, pushing the price toward the $3,500 mark in April. Is this decade shaping up to be one in which tangible assets like gold outperform all other assets? Share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates.